Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, April 3, 2017. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So as you can see on the daily chart, today we came in and tested the 50-period moving average, which is the blue upsloping trend line, and we bounced off that pretty well today, and that's the first or earliest indication that this low is most likely going to hold, and unless we break through the 50 and have a pretty solid down day tomorrow or Wednesday, which I don't think is likely to happen. This low should hold here, and we should put in a little bit of a consolidation pattern that's begun already, and we should have another push higher as early as midweek this week. And if we do, my expectation is that we'll bust through the 237.61, which is this red candle high, and we'll probably make a run for about 238, maybe even the gap fill that comes in at 238.48. That's a little bit up there, but 238, believe it or not, is possible this week. I think in order to do that, we just need a little bit more sideways consolidation to happen first, to work off some of the short-term overbought condition that occurred last week. And once we get that, I think we're able to get a little bit of a push higher, and we'll probably get some kind of a spark coming from some economic data that comes out this week. You have some Fed minutes coming out. You have an employment report coming out. You have Draghi over at the EU speaking tomorrow. Not sure how the market will react to that. That's early in the morning tomorrow. That could present maybe even a pullback a little bit, which would set more of a consolidation pattern up. A lot of possibilities happening this week, but if you take the bigger picture and you take a look at it and say, if you believe that the bullish phase of the year is still intact, and I believe it is, and this was just a pullback in the larger uptrend, right, into last week. And if you still believe in some of the higher numbers that I've been discussing in the Spider, namely the $246 level, and I believe that to be still yet a very distinct possibility, then this should still be a buy the dip market for higher prices coming. We had about a month-long pullback, which is pretty garden variety, and we should be beginning, the next phase of the bull market, which should get underway at any point in time. We should trade up at least through May, as far as my work tells me. And just in order to get a better picture from the longer-term perspective, let's go over to the weekly chart, and what you see here is nothing really is damaging to this market. We had a little bit of a pullback for a few weeks. We had a nice reversal last week off the lows, and we could absolutely continue this bull market higher. This was just a pullback or a consolidation after a short-term, or a little more than short-term, overbought condition, and that's really all we have. This is a pullback in a larger uptrend. When you look at the weekly chart, we couldn't even get down to the 20-week moving average. That is, in no uncertain terms, bullish. And that's pretty much the story in the Spider. So we'll go back to the daily chart. We'll go over to the next market, which is the IWM. And we did have a little bit of a different picture in the IWM today. We did see a little bit of a down day in the IWM, down about 1%, where the Spider was basically flat, down 0.1%. That almost doesn't even count. But the IWM down 1% is somewhat of a divergence. So we'll be a little bit on guard tomorrow for a little bit more of a pullback if it's going to happen. And that's not anything detrimental to the market. It's just the IWM potentially telling us that the market is still consolidating, nothing more, nothing less. If we were to take out the lows, that's a different story. I don't see that happening. But of course, if it did happen, we know where our numbers are on the downside. Nothing has changed from what I've told you before in the previous videos. For example, in the IWM, if by chance we did take out the lows from last week, we take a quick shot right down to the 200 period moving average. There's a gap fill right here at about 127.40, give or take, and that's where the IWM would hold. Likewise, in the spider, the numbers that we have on the chart, and I'll just roll back over there. Probably, or most likely, if we did take out the lows, the 230.23 is no longer in play. We would go down to 228, in my opinion. But I don't see that happening. If it does happen, those are the numbers, so we know where we are. Just to get a fresh look of the longer-term picture in the IWM also, what you see here is, again, this is just a long-standing bullish consolidation pattern in this upper range. So there's nothing wrong. It shouldn't be a squiggly line, but my mouse moved. It just absolutely is a bullish pattern. There's no two ways about it. And until and unless we take out last week's lows, there's absolutely nothing wrong with this market. It's consolidating in a bullish fashion, and what happens after that? We go higher. And when we do go higher, and everything, when we do go higher, everything will get a lift. All markets will rise together. Rising tide lifts all boats. So in this next phase of the bull market, following the corrective phase we just had, and the corrective phase is coming to an end. It doesn't necessarily turn on a dime, but when we do have this next push higher into, let's say, the latter part of April, second half of April, into May, all markets will get a lift accordingly, and that's my expectation. So let's get back to the daily chart in the IWM. You get the bigger picture. And we'll go over and take a look at the transports. And we saw a little bit of a down day in the transports today, down of 1/3%. But again, it looks to be just a consolidation pattern riding the 20 period moving average. All we need is a little bit of a spark, and we'll go higher into the 50 period moving average. My expectation is we're going to see these markets lift at least into or around midweek this week to the latter part of this week. That is what I'm expecting. We no longer need this line anymore, but we'll leave the other ones on. Obviously, we can see we held the 88.30 level last week. That was almost the low in the transports, and now we're trading above that level, building a bullish consolidation pattern. Unless we take out these lows, the market will go higher. If we do take out these lows, we'll have a pretty quick shot down to the 8,400 level in the transports. Similar to the IWM today, I'm going to bring up the XBD, which is the broker-dealer index, and we did have somewhat of a divergence in the broker-dealer index from the other markets, meaning it was down significantly more than the spider, for example. And that is a little bit concerning. Without the financials, we know the market cannot stage a rally, although we'll see if it's just a one-day wonder or not. We're contained by the 20 period moving average. This obviously, like the other markets, is a bearish pattern, okay? So there is the propensity to go lower, and we'll have to take it one day at a time. You know, the IWM, it is a bearish pattern. I just want to bring that back up and make mention. It is a bearish pattern until and unless we clear the red bar high, the red candle high. This does have the possibility to go lower, and just on that topic, the spider, the same thing. I just don't think that we're going lower. I think the corrective phase is over, but we'll have to take it one day at a time. And if we can see a bullish consolidation pattern form like one is forming now in this range here, that will set up for another push higher, and that's what the market needs to get through this red candle high. So back to the broker-dealers. Weakness today, which is a little bit of a cause for concern. Weakness in the IWM, weakness in the broker-dealers is a divergence, okay, but it doesn't change my outlook that higher prices are coming. We just have to be aware of it, and if in fact we are going to trade lower, we'll see these indexes and all indexes come down together. It's just not my outlook, but I am watching the indexes closely. I am watching for divergences. And as we know, the market never makes it easy. Its job is to fool as many traders and investors as possible, as much of the time as possible. But just wanted to point out the divergences and that I am aware of them. Heading over to the gold market today. Gold was up a little bit today. And this daily chart is bullish. There's no two ways about it. We're making a bullish consolidation pattern in this range. So we had an up move, and now we're just consolidating. That's all this was. And this should be setting up for another move higher. Could be as high as about 1275. That's this line here, this purple line here, which is just above the 200 period moving average. That's where I think gold would stall out again. Whether or not we get up that far remains to be seen. We could obviously stop short of that, but that is what the gap fill, that's where the gap fill is, and that would be a natural area for gold to go, but it probably needs a little bit more consolidation before making another move higher. But it is bullish, no two ways about it. We could get some movement in the metals, specifically gold, tomorrow morning early based on Mario Draghi's comments that I believe come out at about 9:30 a.m. Eastern Standard Time, if I'm not mistaken. So watch the metals around that time. Gold could certainly be on the move. Up or down, who knows what it's going to do based on what he's going to say. I don't have any idea what he's going to say, but I know that the metals and basically everything under the sun can move based on his comments for some reason or other. That's the ECB's comments Tuesday morning. Let's go over to the silver market. And silver's making a nice, tight, bullish, it's really a flag pattern. These are even more bullish than a consolidation. It is a consolidation pattern, but it's not even a pullback. It's just a bull flag pattern. This is setting up to challenge this red candle high and potentially go higher. Could happen tomorrow morning on those comments. We'll see. But definitely bullish above the 200 period moving average in a flag formation. That is a bullish signal under normal conditions. Heading over to crude oil. A little bit of a pullback today to come to back test the 50.25 level. That's important, at least on my chart. Crude was certainly overbought on a short-term basis from last week, so it stands to reason that you would see some kind of a pullback, and we saw one today, but it certainly can put in a bullish pullback pattern, a bullish consolidation pattern for another leg higher into the moving averages. We'll see what happens throughout the next couple of days here this week. Chances are we get another down move tomorrow and or Wednesday. This would bring us at least down to the, let's say, 49.50. I got my numbers jumbled. My apologies. 49.50 area, give or take. That would be a natural pullback for crude oil. That is my expectation. I think we'll get some more downward movement. It's overbought. It needs to consolidate for a while if it's going to have another leg higher. So I think we'll get some more pullback in crude in the short term. Maybe even as far down as the 20 period moving average that comes in around 49.29 or so. That would be normal market activity, garden variety pullback. Let's head over to the bond market. We saw a nice big up day in the bond market today. And we're breaking out of this bullish consolidation pattern, and that's what's happening today. We saw the up move, consolidate, and here comes another up move. We should stall out at the 152.23. Doesn't mean we can't go higher, but that should at least put a pause on the market. That's an important level. But you know what I think in the bigger picture, I think bonds are heading up to the 159, 160 level. And so this has been quite the move off the lows that we had back in here. Just real quick, let me bring up the weekly chart and I'll show you where these numbers come from. When you look at the bond market, we tagged the 200 period moving average, we missed it here, tagged it here, and then now we're taking off to the upside a little bit. What happened was, this was a breakdown in the bond market back in November 11th, the week of November 11th. This was the breakdown in the bond market. So what happens is, generally speaking, markets, when they break down, if they can stage some kind of a rally after a breakdown, they will come back to retest that breakdown point. That will be a tremendous amount of resistance. And guess what? There's your 159, 160 level right at the breakdown point. And that's where I'm getting that from. That will be a tremendous amount of resistance on the way back up in the bond market. Now, if bonds are rallying like that, that means interest rates are headed lower. If interest rates are headed lower to that magnitude, there's probably something going on in the stock market that's not good. I don't expect this to all happen this month or next month. It's going to take a while, but in concert with what my expectation is, once we get through May, we should see a stall out in the stock market if, in fact, we've had the rally that I'm expecting. And that could be the recipe for higher bond prices, lower yields, lower stock prices following that last leg up in the stock market. That's kind of my bigger picture thinking. We'll refine that as time goes, but I just wanted to make mention of it once again to refresh our memory. But right now, I don't think it's going to be so easy for the bond market to get through this area all in one shot. I think we'll stall out again, but nevertheless, big up day in the bond market, bullish behavior, nice consolidation pattern, another leg higher. We didn't really consolidate for too long, so I'm not sure how high we can go off this pattern, but we certainly can get to the 152.23. Whether or not we can close a day above that level, that's a different story. And taking a look over at the dollar, another stall out into the convergence of the 20 and the 50 period moving average. Maybe we just go sideways and push higher. Maybe we pull back. I think we'll get some movement tomorrow morning with the ECB comments coming out from Mario Draghi. That should move currencies. It'll move the dollar. It'll move the euro, which is the opposing currency. We'll see what happens. I'm not 100% convinced we're done with the downside in the dollar, although I did not expect us to have this kind of a rally off here. I thought we would at least reach the 200 period moving average. So we'll see if there's another leg down or not. I tend to think there is, but I'm open to ideas that there isn't. We'll take this one day at a time. And with that, I'm going to wrap it there tonight. It's everything I wanted to discuss. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.